All right, welcome to Talk Tickers. Today we are digging into PVH Corp. You know them, right? The powerhouse behind Calvin Klein and Tommy Hilfiger. So they just dropped their Q3 earnings, and on paper, everything looked fantastic. A really solid beat. But then, the stock just fell off a cliff. So the big question is, what in the world did the market see that the headlines completely missed? Let's dive in and figure this out.
Okay, so here's our game plan. We're going to start with that weird disconnect, the beat versus the plunge. Then we'll get into the nitty-gritty of the financials, see what's really going on under the hood. After that, we'll look at the guidance that clearly spooked investors. And to wrap it all up, I'll give you our view on what's next and even a potential trade idea.
All right, first up, you've got the numbers versus the reaction. So let's just set the scene here. PVH drops its numbers and bam, there's this massive gap between the glowing headlines and the stock just taking a nosedive. This is really the mystery we're here to solve today.
Okay, look at these numbers. The company puts up adjusted earnings of $2.83 a share. Wall Street was only looking for $2.56. I mean, that's a beat of over 10%. That's huge. Revenue also squeaked past what everyone was expecting. And the market's reaction? The stock gets hammered, down almost 12%. That, right there, is the disconnect we're talking about.
So, what gives? What on earth spooked investors so badly? If the big, shiny headline numbers looked this good, what was hiding in the fine print that caused such a massive sell-off? Well, the answer, as it often is buried a little deeper in the report.
All right, let's start peeling back this onion. We're going to go way beyond the headlines and really decode these financials. Let's find the numbers that the market actually cared about. Because, you know what they say? The devil is always in the details.
Okay, this table really lays it all out. See the top two lines? Yep, there's your EPS beat, there's your revenue beat, everything looks rosy. But then your eyes drift down to that last line, gross margin, and that is the real story. It came in at 56.3%, which is a drop of 210 basis points compared to last year. That's a huge red flag. It tells you the company's core profitability, not just how much they're selling, is getting squeezed hard.
Yeah, this number right here, minus 210 basis points. This is the whole problem in a nutshell. It completely overshadowed that nice earnings beat. A 210 basis point drop, that's 2.1 percentage points. It's a really big deal. In simple terms, for every single dollar of clothes they sold, they were making less money to actually run the business.
So what caused this? What were the margin killers? Well, you didn't have to guess. On the earnings call, management was actually super clear about it. They pointed to three big headwinds that were really squeezing the profits. And here they are. First, and this is the big one, U.S. tariffs. That alone accounted for about 110 basis points. That's more than half the entire drop. Just poof, gone. Then you had another 50 points from some internal shuffling with their licensed products. And the last 50 points? A mix of running more sales and higher shipping costs. The big takeaway here is that these tariffs were a massive gut punch to their bottom line, and that's something they can't fully control.
But as any seasoned investor will tell you, the market doesn't really care about what you did last quarter. It cares about what you're going to do next quarter. And that, my friends, brings us to the real reason for the sell-off, the guidance. So you get the CEO Stefan Larsson on the call, and he's projecting total confidence. He's talking up their big strategic plan, the PVH Plus plan, and reminding everyone how powerful the Calvin Klein and Tommy Hilfiger brands are. The message was basically, hey, things are a little chalky right now, but we've got a long-term plan and we're sticking to it. And this is where the story really takes a turn. You see, they actually raised their guidance for the full year, just a tiny bit, but nobody cared about that. The market's eyes went straight to the fourth quarter, and their Q4 guidance, it was for $3.20 to $3.35 per share. Wall Street was expecting something like $3.61. That is a massive miss, especially for the all-important holiday season. Ouch. And it didn't stop there. On top of that weak guidance, they started listing off other problems. A slowdown in Europe, some transitory, that's the word they always use, operational hiccups messing with shipments, their jackets and coats weren't selling well, and oh yeah, as the cherry on top, their CFO is leaving. It was just a whole cocktail of bad news.
Okay, so let's put this all together and make sense of it. What we have is a classic case of a headline beat getting completely steamrolled by shrinking margins and a really weak forecast. So with all that in mind, here's our take. This is the next call on PVH.
All right, here's how we see it playing out. Step 1, our Q4 prediction. We think they're going to hit the low end of that guidance they gave. Why? Because those tariff and European problems aren't just going to disappear in a few weeks. Step 2, what's the stock going to do? Well, we think it's likely stuck in the mud for a while, just trading sideways until we see some real proof that those margins are getting better. Which brings us to step 3, our rating. We're calling it market perform.
Now, just so we're all on the same page, what does market perform actually mean? It doesn't mean sell, and it definitely doesn't mean buy a ton of it right now. It basically means we think the current price is about right. It fairly balances all the bad stuff, the tariffs, the slowdown in Europe, against the really good stuff, which is, of course, the incredible power of the Calvin Klein and Tommy Hilfiger brands.
Okay, time for our last section, the trade. This is where we put on our strategist hats and talk about a potential idea based on everything we've just discussed.
So the trade idea here is something called selling a bear call spread. Now, I know that sounds complicated, but here's the simple version. Since we think the stock is probably going to be stuck trading sideways, this is a way to bet on that. It's an option strategy where you're essentially betting that the stock won't have a big rally and go above a certain price. You make money if the stock stays flat or even if it drifts down a bit.
So why this trade specifically? Well, a few reasons. First, it lines up perfectly with our whole theory that a sharp rebound just isn't in the cards right now. Second, after a big earnings surprise, volatility goes crazy, which means the premium you get for selling options like this is usually higher, so more potential profit. Third, and this is really important, it's a defined risk trade. You know exactly how much you could lose from the get-go. And finally, it plays right into what the market is already thinking. The price of call options, which are bets on the stock going up, just cratered after this report, which tells you not many people are expecting a quick comeback.
And of course, we have to end with our very important disclaimer. Everything we've talked about here, the analysis, the trade idea, it's all for informational purposes. Just an educational look at the situation. This is not financial advice. Talk Tickers isn't your financial advisor. Please do your own homework and talk to a professional before you make any decisions with your own money.